My name is Joseph Kemani, your lecturer for financial reporting and advanced financial reporting. So in this session, I want us to start on an important topic, and the topic is accounting and also the preparation of financial statements for interest in other entities. So as far as this particular topic is concerned, we're going to look on two important subtopics. The first subtopic is the topic to do with the group accounts, or the presentation or preparation of the consolidated financial statements. And also later on, we are going to look on another important topic or subtopic to do with the branch accounting. So, but to start with, I want us to start by looking on what are group accounts, or basically what are consolidated financial statements, the presentation of the same, and also the various accounting standards which are applied during the preparation of the group account. So therefore, first of all, when we talk about the group account or the consolidated financial statement, these are those financial statements which are prepared by a parent entity which has some interest, or basically which has invested in other entities, of which now when talk about the parent entity, we can refer to it as the investor because it has invested in other entity, whereas now the other entities, we can refer to them as the investee companies, of which in this case we are going to look on various forms of the investee companies, because an investee company can be a subsidiary, it can be an associate, it can be a joint arrangement, or basically it can be termed as what? As a mere investment. But maybe to start with, we can say that group accounts which are also known as the consolidated financial statements, are financial statements or final accounts prepared by a parent entity. So the parent entity, in this case, we are referring to this as the investor, the parent entity, which has interest in other entities, which has some interest in other entities, and basically the other entities which the parent company has invested in, we refer to them as the investee company, or basically companies. So therefore, is a requirement that a parent entity, or basically a parent company, has to prepare the group account at the end of each financial year, and that is a requirement under the Companies Act and also under the various accounting standards. Now, in this case, when we talk about the investee companies here, we have various types, and maybe you can just mention that. So we can say the investee company, or basically entity, can either be, number one, we have a subsidiary. We have a subsidiary company. So when talk about a subsidiary company, this is basically a company over which the parent company has a control, or basically this is an investee company whereby the investor company has a control. And basically in this case, we say that the parent entity has a control if it has acquired shares which lies between 51% to 100%. So therefore, we can say that this is an entity. This is an entity controlled by the parent company. Controlled by the parent company. Remember, in this case, we are saying that the parent company here is the investor. So therefore, a subsidiary is a company which is controlled by the parent company. So basically, by saying that the subsidiary is controlled by the parent company, it means that all the operating and financial decisions which are made by the subsidiary company are controlled by the parent company. And also, on the other hand, the composition of the board of directors of the subsidiary company is controlled by the parent. So, and in this case, we have said that a company shall be regarded to be a subsidiary whereby the parent company acquires shares which lies between 51% to 100%. To 100 what? Percent. So basically what that means is that if you come across a question in an exam setup and maybe you're told that A Limited here, for example, acquires shares or basically equity or ordinary shares of B Limited, and those particular shares lies between 51% to 100% of the ordinary shares or basically equity shares issued by B, then automatically B here will be the subsidiary company. This will be the subsidiary company, whereas A Limited will be what? Will be the parent. Therefore, what we are saying is that under the requirement of the Companies Act, that this particular company here, because it has a control over B, at the end of the year, it is required to prepare the group account or basically the consolidated financial statement. So we're going to look on how those particular group accounts are prepared at a later stage. But on the other hand, this particular investee company, we are saying it can either be a subsidiary. Number two, it can also be an associate. It can also be an associate. So when talk about an associate, basically this is a company over which the investor has something called significance influence. It is an entity over which the investor company has a significance influence. So therefore we can say that this is an entity over which the investor company, remember in this case when talk about the investor company, we are talking over the parent company has a significance influence, influence. And in this case, we say that an investor or basically the parent company has a significant influence if the parent company or basically the investor company has acquired shares which lies between 20% to 49%. To 49 what? Percent. So mean that if, for example, we are told that A Limited acquired between 20% to 49% of the equity shares or ordinary shares issued by B Limited, then it means that A Limited here will be the parent company. This will be the parent company, whereas this will be the associate. So reason being that A Limited here will be having something called a significance influence. Significance influence means that A Limited do not have the powers to control the operating and financial decisions which are made by B Limited, but A Limited has the powers to influence, not to control, but rather to influence the operating and financial decisions now which will be made by B Limited, which is known as what? As the associate. So therefore, an associate is that particular entity over which the investor company or the parent company has a significance influence. On the other hand, the investee company can also be a joint arrangement, previously known as a joint venture. And basically when we talk about a joint arrangement, we say that this is an entity over which the parent entity and another entity acquire something called a joint control. So we can say that this is an entity over which the parent company and another entity a parent entity and another entity have a joint control. Have a joint what? Control. What does that mean? It means that the parent entity here and basically another entity, they have acquired a 50% shareholding in that company, which is known as a joint what? Arrangement. Like maybe in this case, we assume that we are told that we have a company here which is called maybe a B Limited, we can be told that X Limited and also Y Limited, these two companies have acquired equal shareholding, or basically have acquired shares which are equal, that is 50% of the shares issued by what? By B Limited. So mean that if X Limited, Y Limited both acquire 50% shareholding of B Limited, then we say that these two companies, that is X Limited and Y Limited, they have a joint control, meaning that the operating and financial decisions now which will be made by B Limited, those decisions are jointly controlled by the two entities here, that is X Limited and also what? Y Limited. Therefore, this company here is known as a joint arrangement, and previously this one was known as a joint what? A joint venture. So on the other hand, the investee company number 4 that is, can be a mere investment, can be a mere investment. So in this case, when we talk about a mere investment, this whereby the parent entity, or basically the investor company, or the investor has acquired shares which are less than 20% of the shares issued by the investee what? Company. So therefore here we can say that this is an entity over which the parent entity or the parent company, company, which is also known as the investor, holds less than 20%, hold less than 20% of the issued equity or ordinary shares, equity or ordinary shares, equity or ordinary shares. So mean that if, for example, you're told A Limited here has acquired shares which are less than 20%, that is 1% to around 19% of the shares issued by B, then we say that that investment by A in B is a mere investment. Is a mere what? Investment. And basically such a mere investment is then termed as a financial asset, and basically this one should be accounted for in accordance with the International Financial Reporting Standard number 9. So therefore, in this case, what you have said is that the group account, or basically the consolidated financial statement, are supposed to be prepared by a parent entity, or basically an investor which has some interest in other what? Entities. In this case, we are saying that the other entities whereby the parent company has invested, then we have referred to them as the investee companies. Now, these investee companies, we are saying can either be a subsidiary, can be an associate, can be a joint arrangement, or basically can be what? A mere investment. Now, in the first part of this particular topic here, we're going to look on how we prepare the group account or the consolidated financial statement, specifically whereby the parent company has invested in a subsidiary. But at a later stage, we're going to look on how the group account or the consolidated financial statement are prepared, whereby the parent company has invested in an associate, has invested in what? In a joint what? Arrangement. But when it comes now to a mere investment, this is not supposed to be covered at this particular topic here, but that is supposed to be covered in a different topic of a financial instrument, whereby as a candidate, you look on how a mere investment is supposed to be accounted for in accordance with IFRS 9, and equally you look on the various types of financial what? Financial asset and so on. So, but maybe you can start by, or before you look on how the group accounts specifically are prepared, I want us to define some key important terms, and then from there we look on some of the standards which are applicable during the preparation of the group account. So therefore, here we're going to start by looking on the preparation of the group account, whereby the parent company has invested in a subsidiary. So we start by looking on the preparation of group account, whereby we have an investment in a subsidiary, investment in a subsidiary. But even before we look on how those particular group accounts are prepared, first of all, we need to define some terms here. We look on definition of terms. Definition of terms. So some of the terms we need to define here include the term group. So basically, when we talk about the group here, we are referring to a group of companies. So what is a group of companies? A group of companies, basically, this refers to a parent company and its subsidiaries. The parent company and its what? Subsidiaries. So mean that if, for example, you have a parent company having like 2 or more subsidiaries, or even a single subsidiary, then the parent company and its subsidiary, all its subsidiaries, then we can refer to that as what? A group of companies. So therefore, you can say that this is a parent company and its subsidiaries. So the other term we need to define here is the parent company. The parent company. Remember, in our introduction, we have mentioned what is a parent company, which we have also referred to as the investor company. So we have said that this is a company which has invested or which is having some interest in other entities. So a company is deemed to be having some interest in other entities, whereby that company has invested in other entities by acquiring shares. By acquiring what? Shares. But in this case, we can say that the parent entity, we can say that this is an entity having a control over another entity, which is now known as a subsidiary. The other term we need to define here is the subsidiary. Subsidiary. So when we talk about a subsidiary company, we can say that this is a company now which is controlled by the parent. The parent. So we say that this is an entity controlled by the parent. Parent entity. Essentially, what you have said here is that a company will be controlled, or basically a parent company will be controlling another entity, whereby the parent company holds or has acquired shares which lies between 51% to 100%. 100 what? Percent. Meaning that the parent company is in a position to control the composition of the board of directors of the subsidiary company by appointing majority of the directors of the subsidiary company. And number 2, we have said that the parent company is the one which controls the operating and financial decisions made in the subsidiary company. And therefore, we are saying generally, a parent company will be having a control over a subsidiary if the parent company acquires shares lying between 51% to 100%. So, and then from there we can also define the other term here, number 4, and that is the term business combination. Business combination. So when talk about business combination, this is the transaction through which the parent entity acquires control over the subsidiary. For example, in this case, if we are told that A Limited here maybe acquired like 80% of the ordinary shares or equity shares of B on 1st of January 2024, that particular date, when A Limited acquired majority of the shares in B, then we refer to that transaction as a business what? Combination. That's why we are saying a business combination here is a transaction through which the parent entity acquires a control. A transaction in which the parent entity, entity acquires control over subsidiary company. So the other term, number 5, is a non-controlling interest. Non-controlling interest, which is abbreviated as NCI, So what do we mean by NCI, non-controlling interest? So basically this refers to the shares issued by the subsidiary company and which are held by the minority shareholders. Like in this case, let's assume that you're told that A Limited here acquires 80% of the shares issued by B Limited. So it basically means that A Limited here will be the parent company, because you can see the parent company controls, or A Limited controls B, and then we have now the remaining 20% of the shares which are issued by B Limited. So those 20% of the shares issued by B, then in this case we say that they are held by the minority shareholders. So why do we refer to these other shareholders as the minority shareholders? Generally, we know that in a company, decisions are made by the majority shareholders. So therefore, those shareholders who hold just 20% of the shares issued by the subsidiary, they cannot control the operating and financial decisions made by the subsidiary, that is B Limited. They do not have now the powers to control the composition of the board of directors of what? Of B Limited. So therefore we say they have some interest in B Limited, but their interest is a non-controlling. They can't be able to control operating financial decisions, and also even they cannot be able to control the composition of the board of directors of B Limited. So therefore we say NCI that these are shares, and specifically we are talking of equity shares. These are equity shares issued by subsidiary company, not held by parent company, not held by the parent entity, not held by the parent entity. So therefore, shares issued, or ordinary shares issued by the subsidiary company, not held by the parent company. In other terms, we can say that these are those particular shares which are issued by the subsidiary company and which are held by who? The minority shareholder. So therefore, the interest of the minority shareholders in a subsidiary company, we refer to it as NCI, non-controlling what? A non-controlling interest. So therefore, these are basically some of the terms you need to know. As far as the investment in a subsidiary is concerned, you need to know what is a group of companies, which you have said is a parent and its subsidiaries. The parent company you have said is a company having a control over the subsidiary. Subsidiary company you have said is a company controlled by what? By the parent company. And also we have said that that transaction through which now the parent company acquires a majority of the shares in the subsidiary, that transaction we refer to it as a business combination. And also here we have also been able to define the NCI, non-controlling interest, which you have said, these are shares in the subsidiary, shares issued by the subsidiary, but which are held by the minority shareholders. So I want us to stop at that particular point. So once we come back in our next session, I want us to look on some of the accounting standards which are applicable during the preparation of the group account, or the preparation of the consolidated financial statement. And then from there, we look on some of the specific standards Starting with IFRS 3, we see what IFRS 3 says, and then from there we proceed to the other standards. So therefore, see you in the next session.
Welcome back to the lesson. Today we are going to examine the purpose of strategy. You recall that we defined strategy as a well-defined, deliberate, comprehensive plan that is designed to achieve long-term objectives of an organization. So the purpose of strategy is to define a clear direction for an organization, outlining its goals, the methods of achieving it, and the resources that are required to do so. So an effective strategy serves several key purposes, and this is what we are going to examine in our today's lesson: the purpose of strategy. The first purpose of strategy is that strategy provides direction. Strategy provides direction. It sets the overall direction for an organization, acting as a roadmap that guides decision making and resource allocation. A strategy helps everyone within the organization to know what each and everyone is required to do. It helps ensure that everyone in the organization is working towards a common set of objectives. It gives the direction. This is where we are moving, right? That is the direction. So everyone works towards achieving the objectives. So it helps the members within the organization to work towards a common set of objectives. That is the first purpose of a strategy. A strategy can also create what we call a competitive edge. Creates a competitive advantage. Creates a competitive advantage. Strategy helps organizations identify and develop unique strengths, unique capabilities that differentiate them from competitors. And that then enables an organization to create a competitive advantage that allows them to outperform rivals in the industry. That's the second purpose, creating a competitive edge. A strategy also aligns of resources towards achieving the intended objectives. It helps to an organization allocate its resources, and these are financial resources, technological resources, human resources, capital resources, in a way that maximizes their impact and supports the achievement of strategic goals. A strategy can also help to manage risks. Now, strategy involves assessing and mitigating potential risks that could threaten an organization's success. Identifying and mitigating potential risks, because a strategy is a predetermined course of action. It is essentially a plan. So an organization is able to identify potential risks, then put in place mitigating measures to ensure that the organization succeeds. And by proactively addressing risks, organizations can increase their chances of achieving their goals. That's the fourth purpose. 5, a strategy can help the organization to adapt to change. Adapting to change. Now, in today's dynamic business environment, strategy is crucial for adapting to changing circumstances because it allows organizations to anticipate and respond to emerging trends, contemporary issues, technologies, emerging technologies, market conditions, and so on. Adapting to change. Strategy can help create value, can be key in creation of value. Ultimately, candidates, the purpose of strategy is create value for the organization's stakeholders, including employees, the shareholders, customers, lenders, and the broader community. And such value can be financial. This value can be, it can be social. The value can also be I greet you all and welcome you to the lesson. We are going to introduce a new subject known as strategic management. The unit description reads as follows: that the aim of the paper is to strengthen the strategic thinking capability of the candidate in formulating and implementing a corporate strategy that can help organizations build a sustainable competitive advantage. The paper has the following learning outcomes. By the end of this paper, you should be able to, 1, analyze an organization's environment and formulate an actionable business strategy that is grounded in theory and practice from multiple business disciplines. 2, demonstrate an ability for critical and strategic thinking. 3, develop and implement a realistic strategic plan. 4, understand the strategic decisions that organizations make in strategic management. And lastly, effectively react and incorporate emerging issues in strategic management. These are 5 learning outcomes. Now, candidate strategic management is a comprehensive approach to managing an organization that focuses on the formulation, implementation, and evaluation of cross-functional decisions that enable an organization to achieve its long-term objectives. And it involves a systematic analysis of an organization's internal and external environments. It also involves setting goals and developing strategies to achieve those goals while continuously monitoring and adapting to changes in the business environment. So strategic management is a comprehensive approach to managing an organization, and it is a process that begins with formulation, implementation, evaluation, and so on. And all these processes also have sub-processes. So you are required to be able to strengthen the strategic thinking capability in your strategic thinking capability. You are required to develop the thinking and strategic thinking capability that will help you in formulating and implementing corporate strategy that can help organizations build a sustainable competitive advantage. And I've outlined the learning outcomes. Now, this paper is organized into 15 chapters. There are 15 chapters. Chapter 1 is overview of strategic management. Chapter 2, history of the organization and culture. Chapter 3, strategy levels and intent. Chapter 4, strategic management process. Chapter 5, strategic analysis, that is the external environment. Chapter 6 is on strategic analysis, focusing on the internal environment. Chapter 7, business strategy and models. Chapter 8, corporate strategy and diversification. Chapter 9, international strategy. Chapter 10, strategy development process. Chapter 11, matching organizational structure to strategy. Then we have the next chapter 12, leadership and strategic change. Chapter 13, the practice of strategy. Chapter 14, strategic control. And chapter 15, contemporary issues and case studies in strategic management. These are 15 topics. And by going through all the 15 topics, you as a candidate should be able to meet the learning outcomes that I had read earlier. And I've defined strategic management as a process, and you can see the chapters help us achieve that goal. The chapters are arranged in a systematic manner. You can see in chapter number 1 is an overview of strategic management. Chapter 2 is history of organizational culture. Then we have strategic levels and intent in chapter 3. In chapter 4, we will outline the strategic management process. You can see chapter 4, subtopic 1 is on steps in strategic management process. We will be able to go through the steps in the strategic management process. Then part of the steps may include the internal and external analysis as outlined in chapter 5 and chapter 6. Then we have strategic control, strategic implementation. So you'll be going through all the stages in the strategic management process. And I've said it focuses on formulation, implementation, and evaluation of the cross-functional decisions that enable an organization to achieve its long-term objectives. For an organization to achieve its long-term objectives, then it has to be committed to a systematic approach in strategic management. You understand? So candidates will be studying each and every topic, each and every subtopic. We will tackle every aspect of the syllabus. Like in chapter 1, there are 7 subtopics. So we will be dedicating each lesson to a subtopic. For example, in our lesson, we will start on the concept of strategy. That is the first chapter, first sub-chapter. So each lesson will be dedicated to each of the subtopics that are highlighted in the syllabus. And at the end of every lesson, I'll be giving you revision exercises, which I expect you to do. As you come to this class, I also expect you to take notes. Kindly participate in the learning process. Make sure as we are going through the content, take notes. Then keep on revising by way of answering the questions. And over and above the video lectures, we also have study materials. We've done study texts. We also answered all past paper questions that have been examined by Kasneb. All the past papers under the revised syllabus, we have revised all the questions. Therefore, I also expect you that at the end of every lesson, please go to the revision book, attempt the past paper questions. Answers are provided at the back of the book. Ensure that you counter-check your answers. In case you may have any questions, please feel free to send your questions. Below this video, there is a comment section where you can post your questions and all your questions will be answered. So as your instructor, I have a role to play, and as a candidate, you also have some roles to play, including appearing in the lessons, taking notes, asking questions, doing assignments, and so on. When you do that, then these objectives will be met. Of course, you remember that the purpose of you attending these classes is not limited to passing the exam, but also being able to perform the learning outcomes mentioned